Thanks for clicking! The Toronto Regional Real Estate Board just released its data for the month of November, showing a real estate market that is continuing to slow down, with prices dropping for the fourth month in a row.
It's going to be a busy month.
Indeed, but not to worry, as the widespread headline showed soon thereafter, help very well may be on the way, with TRREB President Paul Baron saying that rate cuts are coming to a theater near us soon. Yet, this is a bit of a departure from the TRREB that we heard from last year, when they noted that, without a major increase in supply, the housing market would become even less affordable once the 2022 correction subsided. So, the TRREB said last year it was supply that would make housing more affordable. This year, going into 2024, it's going to be interest rates, which begs the question, will interest rates make the Toronto market any more affordable than it is right now? So what I want to do today is go over Toronto's real estate data for the month of November, take a look at the link between affordability in Toronto and interest rates, and then discuss what to look for next. Speaking of next, the Bank of Canada is set to make its rate announcement on Wednesday, and we'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. First up, the benchmark price. The benchmark price, if you remember, that's the price of a home that has the most popular set of features. The benchmark price in Toronto in October was $1,103,600, and that dropped down to $1,081,300 in November. So that's a $22,000 drop in the benchmark price in 1 month's time, and an almost $90,000 drop since Toronto hit its benchmark peak in June of this year. And the average price fell even more substantially than did the benchmark. The average price in October was $1,125,928, and that fell over $40,000 to $1,082,179. So that's a price drop of almost $44,000 in just 1 month's time. And the median price also fell substantially, though not as substantially as did the average. The median price, if you'll remember, that's where half as many homes sold or sold over that price and half as many sell for less. The median price in October was $959,500, and that dropped down a little over $30,000 to $927,950. So the median price dropped down to about $930K, lower than the $940K that it was back in February.
I think we're going to have a banner year.
Next up, the months of inventory measurement, the MOI, which measures if no more homes came to market in Toronto, how long would it take for Toronto to completely run out of homes for sale? The MOI in October was 2.4 and remained at 2.4 in November. So, relative to demand, inventory isn't getting any better in Toronto, but prices are still falling. And finally, the sales to list price ratio, which measures by how much a home sells over or under asking. So if the asking price was $1 million and the home sold for $900,000, the SLPR would be 90. The SLPR in October was sitting at 99 and is now sitting at 98. Homes are continuing to sell for under asking price, not by much, but under asking nonetheless. So we have the benchmark price down $22K, the average price down almost $45K, the median price down $30K, inventory has remained relatively static, and homes are selling for less than asking price. Yet, says TRREB President Paul Baron, if you're worried how these price decreases will prevent you from buying a home, fear not, the Bank of Canada may be cutting rates in the first half of next year. Further, said Baron, it's not just the Bank of Canada that is going to be cutting rates, as bond yields, which dictate fixed rates, have been trending lower, both of which will help to alleviate affordability issues for both homeowners and for home buyers. And that is definitely true. Bond yields have in fact been trending lower, with the yield on a 5-year government bond down almost 100 basis points since October. In fact, the last time that yields were this low was back in May, back when the Bank of Canada Governor Tiff Macklem was warning that it was too early to be discussing rate cuts. Let's say that Baron is correct and yields do continue to come down, maybe even reaching their 2023 low that we saw in March when they were at 2.766. Back when the benchmark price in Toronto was $1,118,500. Back then, a decent 5-year uninsurable rate. Remember, since the purchase price is over $1 million, it's uninsurable, so it requires 20% down.
I really should write that down.
Back then, a decent 5-year fixed uninsurable rate was sitting at 4.94. Buyers had to qualify at 6.94, meaning they had to earn about $200,000 per year as long as they had zero debt, and we used a 25-year amortization. Except, when yields were that low, prices didn't stay that low in Toronto, moving up over the next couple of months, eventually hitting $1,171,300 in June, which, by then, even using the old rate from March, using that 4.94, buyers now had to earn $220,000 to get that same benchmark price home. Fast forward a few months to right now, and as we just saw, that benchmark priced home has dropped and is now sitting at $1,081,300 using RBC's current rate of 6.49, qualifying at 8.49. Buyers still have to earn that $220,000 to get that benchmark priced home. So, affordability in terms of a purchase hasn't changed with higher rates. In fact, affordability is just about the same as it was a few months ago. It's just about the same as it was when rates were much lower. Yet, despite the headlines, we know that lower rates tend to bring higher prices, and higher rates tend to bring lower prices. In fact, the only thing that halted the upward march of Toronto's benchmark price in the summer, back in July, was the increase in rates. Otherwise, the benchmark price probably would have gone higher, and with it, affordability would have decreased. So, while lower interest rates might momentarily, as in the moment that they happen, make housing more affordable, as we just saw, that does not last. So, when Paul Baron says that lower interest rates will bring relief to those entering into the housing market, and the media regurgitates it, the caveat, which is rarely included, should be that yes, affordability will get better, but only for a few months.
And we must act now.
So, we have the benchmark, the average, and the median price all down in Toronto in November. We have the real estate board saying that lower interest rates will be better for everyone, news at 11. And also news at 11, history and math contradicting what is said by the real estate board and parroted by the media. With that said, Baron is correct. Bond yields are down, mortgage rates are following, all on the assumption that the Bank of Canada is going to end up lowering rates sooner rather than later, going into 2024. We will continue to track Canada's central bank into 2024. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.